Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and in today's episode, we are going to give our monthly update. In my portfolio, I've made some slight changes, and I'm looking to make a lot more, so stay tuned in the coming month of March because there's going to be a lot of new changes. I'm looking at potentially dropping some companies down, bringing some new companies into the portfolio, so be expecting some changes. But as for the month of February, we are now going to give the updates for my annual and monthly dividend income, so go ahead and take a mental picture of these charts and get ready for an update in 3, 2, 1. And there you go. There is the update for my annual and monthly dividend income. My annual dividend income, as you can see, did increase quite steadily from $315 annually up to $355. And what's so exciting about this is that I'm now reaching the point to where every night when my head hits the pillow, I'm going to be making $1, no matter what. That will obviously be going up over time as well as I reinvest my dividends, make more deposits, get referral bonuses from you guys, and my companies raise their dividends. But 355 is something I'm very happy with. 365 for me will be a really big milestone, and we should be hitting that next month. And then monthly dividend income, as you can see right here, $14. It wasn't the best month by any means, but usually February is really a dead month. Usually for me as a dividend investor, March, June, September, and December are usually the big months for me where the dividends really take off. So this next month in March should be a record month. And I don't know the numbers yet, but I'm thinking it should be around $40 this month. So stay tuned for that. I'll give an update next month. But that was my monthly dividend income and my new updated annual portfolio dividend income. But let's go ahead and scroll down and give an update on my portfolio value and my monthly YouTube income. Okay, so once again, here's my portfolio value for the end of January and my monthly YouTube income that I made in January. And let's go ahead and give you the updates on these two charts right here in 3, 2, 1. And there you go. There's the updates for my portfolio value and monthly YouTube income. The portfolio did uptick quite a bit, over $1,000, about $1,300 in total. We went from $9,200 up to $10,500 in the portfolio, and then the monthly YouTube income. I just wanted to give you guys a quick thanks, and I'm going to show you exactly how I made this income. But $1,000, over $1,000, is absolutely incredible. I mean, I'm a part-time worker at a bank right now, at a credit union. Guys, $1,000 is just so much money and so much more than anything I ever could have expected. On my average months when I'm making $300 a month, for me being a part-time worker, paying my own bills all through school, $300 a month goes so far. Over 1,000, 1,112 to be exact, it's literally life-changing. So that amount of money really is just, it's literally changing my life. And I will be having some new updates to this channel in the coming months, so stay tuned. So I expect these numbers to start uptrending as well. But over $1,000 was incredible, and I'll show you exactly how I made that. Because in this channel, we disclose everything in my YouTube channel, including the income. So I want to show you guys, here's my month-over-month income. We made 94 in July, 135, 214, 141, 121, 152, 103, and then we get to February and I made $167 from ads. So when you're watching these videos and you see a quick ad break, then every time you watch that, I will make about roughly, say, a penny every time you watch one of those ads. So it really helps that you watch the video all the way to the end and you help watch all those mid-ad breaks because it really helps benefit me and my channel. But I know you might be looking at this number and saying $167, Jordan, that's like nothing. That doesn't even come close to this amount. Well, I'll show you where the rest of the money came from. If we go to my content tab here and we click details on any one of my video, in the description there's these thing called mentoring calls. So when you use that, you will sign up for a mentoring call with me, and I charge by the hour and I help get you guys started with investing. For those of you that have no guidance, for those of you that don't know where to go, don't know where to turn, and need somebody to help guide you. It's not financial advice, it's just strictly my personal opinion, but I offer a lot of value there, and I made about $225 last month just from mentoring calls. And where the rest of the money came from was huge. And when we look at this, you see that I make a large part of my money from referring people to M1 Finance. The free brokers that I use, that is incredible, absolutely no fees, so many awesome features that so many other brokerages don't have. M1 Finance is the company that I fully stand behind. It's where I have a lot of my net worth inside of. And if we go to my activity feed here, and you look as we go through my activity feed, you see how many referral bonuses I have. You can see that these were $30 a pop. Usually it's only $10 for getting people signed up with M1, but M1 Finance was having a promotion in January and February where I got $30 per person. And you can see, if you count these as I scroll along, you can pause the video and count them, there were 24 of these referrals. 24 referrals were paid out to me in February. And so go ahead and do some quick math there. 24 times 30, that's a lot of money. And that's where the vast majority of this YouTube income came from. So thank you guys for getting signed up. And speaking of which, as the plug, if you guys want to get signed up, we finally also hit another milestone of breaking 100 referrals. The goal for 2021 is to get 150 people signed up. And so now we have 101 people signed up. And go ahead and use that link down below in the description. It would really help me out. And if you want to invest in the pie that I invest in personally that you'll see throughout these videos, and if you want to stay up to date with my changes, go ahead and check out all the stuff in the description. I'd invite you to subscribe. But go ahead and check out the first stock out of the 23 that I own. We're going to go through every single one like I do every single month to give you guys just a basic rundown about why I own these companies and my plans moving forward. My number one position in my portfolio, which right now is really underweight, so I should be purchasing more of it very, very soon, but Broadcom is one of the companies in my portfolio that I'm most bullish on. I am so bullish on Broadcom for many reasons. It's due to reasons for the fact that this company has tens of thousands, well into the 5 digits, of patents. This company has so many products that only Broadcom can make, and they're one of the most profitable and most successful semiconductor companies in the world. They have a lot of major partners like Apple and Samsung, but they're diversified between multiple categories and multiple products. Now, they have a lot of speculation going into them about the new products that they're going to be making involving 5G and Wi-Fi 6, all high growth categories, but furthermore, this company has CEO, as you can see right here. His name is Hock Tan. He's very visionary. He's an awesome leader with an incredible track record. And this company, as well as their CEO, does not focus on short-term profits. It's not focused on some new type of hype growth story. This company is focused on long-term value for shareholders. And that's why this company has done two things. It has raised its dividends massively, and I mean massively, over the last decade, and the share price has skyrocketed. I mean, just 5 years ago, this was a $150 company, and now we're edging up towards $500. And so I've been standing behind this company, buying it like crazy at $200 and $300 a share for the past year now, and even at $500, $400 a share, whatever the case may be, I am buying this company still at these levels. I am very bullish on it. Still has about a 3% dividend yield. They raised that dividend over 10% just the other day, and it's one that I'm definitely betting on going into 2021. I am not selling that stock. It could go to $1,000 a share. I'm probably still not selling that company, okay? Next up, we have my two real estate companies, the 2 out of the 3 real estate investment trusts that I own, and they are Realty Income and WP Carey. And I've talked so much about these over the last coming months, and this is so unique because Realty Income is the only stock in my portfolio that pays monthly. They pay every 30 days, and they raise that dividend at least quarterly. And the same thing for WP Carey. They pay out quarterly, but they also raise quarterly as well. This is one also the highest yielders in my portfolio and is the biggest dividend payer, as you can see from this left-hand column right here that I'm highlighting. These columns show what these companies pay me annually, and WP Carey is the highest one of that, paying me out $44 a year, just this one company alone. Now, these companies are very undervalued. They're very sustainable. They have extreme profitability, and I expect great numbers going forward. Interest rates are at rock bottom levels, and that's awesome for real estate. So if there's any two companies that I'm bullish on going into the future, it's real estate. Real estate is very undervalued. I anticipate on owning these companies well into the future, well past 2021. Next up, we have one of the only companies in my portfolio that I don't really focus on cash flows really hardly at all, and I'm just focusing on the dividend growth. The yield is horrible. The yield is just flat out terrible. What is that, like a 0.6% yield? I'm not even going to beat inflation with this, okay? The dividend yield is garbage, but the dividend growth is incredible, and I expect the share price growth to be incredible as well. And it's funny because I've been following this company for a long time, and I've always talked about the margins of this company. This company can convert $1 in revenue to $1 of profit incredibly well. And I actually saw a posting the other day. I need to do more research in this. I saw an article that said that Visa was the highest gross margin business of any other company in the S&P 500. And I'm not sure about that. Don't quote me on that. I haven't verified that yet. But I would not be surprised one bit if that's accurate. I tell you what, if it's wrong and if it's not the number one, it's definitely in the top 10 for sure. Because this company has such high margins. When they get $1 revenue, it's almost instantly converted back into profit. They have 50 and 60% margins in some cases. And because you think about it, this company is almost all software. It's almost all digital platforms between their online and mobile payments, and then obviously the Visa network through their credit card and merchants that they issue things out with. But Visa is a company that I'm very bullish on. And like I always mention every month in one of these videos, if there's anything that I'm bullish on with Visa, it's that 85% of the world's financial transactions are still done in cash. So that bodes very well for Visa. A lot of room to grow there, especially internationally. And with their very high margin business, their very low payout ratio, for me as a dividend growth investor, I would be absolutely I would not be surprised one bit, if not even as a joke, if the amount that they pay per share in dividends literally 10x's over the next decade, maybe over the next 2 decades. But this company is going to raise dividends massively. It's going to grow revenues and profits massively, and it's one that I'm very, very bullish on. And that's why even without pretty much no cash flows that it provides to me, I think its payout is like literally $1 a quarter. It's one that continues to be one of my largest positions in my portfolio. And speaking of one of my largest positions in my portfolio, as you can see from this chart, this originally started out at 2 or 3% of my portfolio, and I have steadily been buying JP Morgan like crazy. What originally started as a $20, $30 position up to over $1,000. So I've been buying this company very steadily. I now own about 3.5 shares of JP Morgan, and it has just crushed it. And when I was buying this company in the $90 and $100 a share range, and I was standing behind it, a lot of people couldn't wrap their heads around where JP Morgan was going. And this company, I think people don't realize, it is so much more innovative and adapted to its environment than other companies like, say, a Wells Fargo or something like a Bank of America. When you think about JP Morgan, you think about the future. You think about adaptive, innovative companies that are going to be around long term and is sustainable. JP Morgan is the one of the only financials company that I can think that is able to do that. Other competitors like a Wells Fargo, Bank of America, Goldman Sachs, a lot of these are not going to perform as well as JP Morgan because this company is focusing on things like Bitcoin, on digital transactions. It is now coming out with a competing product to Square. And this company, not only that, but it's one of the most profitable, one of the best banks in my opinion, just on a brand name as well. And JP Morgan is one that I'm betting on. And while it's at $150 a share, it doesn't offer quite the value as when I was buying it at $100 and under, but still $150 a share. I'm very bullish. I don't know if I'll keep that target percentage going forward. I might look for other opportunities, but I'm definitely not going to be selling any amount. If I do lower it, I might just be lowering my target amount, but I will not be selling a single share because I love JP Morgan. But I don't know. Stay tuned for that. One of the newest companies in my portfolio and one that I've been buying so heavily because I started with this being like 2% of my portfolio and now it's upwards of 5% of my entire net worth because Lockheed Martin, it's a steal. It's such a steal because when you look at this, look at these prices, okay? I'm hovering my mouse over what was early 2020 numbers, okay? This company had been priced at $430, $440 a share, okay? So what is that? That's upwards of like, say, like a 20% move upwards from where we're at right now. This company was being valued 20% higher over a year ago, right? Now, the funny thing is, in that time, from where I'm hovering my mouse back at $440 a share, since then, this company is now more profitable. This company now has more revenues. They have acquired a new company, Aerojet Rocketdyne. They now have a new CEO, which is very, very good. I've talked about that in previous videos. Go check out my Lockheed Martin videos if you want to hear about Jim Taselet. Overall, this company is just at a rock bottom valuation. It has a forward PE ratio that's just a joke. It's so much lower than its peers. When you look at the average in the S&P 500, a lot of your big tech names are trading upwards of 20, 30 forward PE ratios. S&P 500 average right now, I think it's like a 25 last time I checked. Well, last time I checked for Lockheed Martin, its forward PE ratio I think was like a 17, 18, something like that. So undervalued out of the market, also has a dividend yield that's about double of that of the market at about 3%, has a steadily growing dividend yield that usually grows every year at upwards of 10%, including last year. And if you look at all that, it bulls that a recipe for success. I don't know what the negative sentiment around this company is, and not to mention it is very defensive, no pun intended. This company is going to do fine through just about any recession, including the 2020 pandemic. They had their revenues grow. And speaking of revenues, one last thing I will say about Lockheed Martin actually before I get off of it. If there's anything that bodes well for this company that says it's going to be successful in the next couple of years, this company is currently being valued at $95 billion. Okay, not bad. This company has a backlog, not orders, the backlog, orders that they can't fill right now because the demand is so high and because their orders are so long structured out. They have a backlog order of $150 billion, worth 50% more than the entire company being valued at today. They have so much revenue. Not even what they're doing now, that doesn't count current orders. Their backlog is over 50% larger than the entire company. So I'm very bullish on Lockheed Martin. It's such a steal, guys. It's, once again, if it could go back to those all-time highs, it could go to say something like $500 a share, and I would still be extremely bullish on it. Southern Company is just a boring utilities company. It's one that basically I look at. It's not one that's super innovative. It's going to be really slow. And while it's not very appealing to me as an investor that is my age at 22 years old, it's one that I can sleep well at night owning. And I was very attracted to buying this company when it was at its rock bottom peak valuations, because it was being valued at $40 and $50 a share. And the yield on this thing, when I originally started buying it, I think it was a 6% dividend yielding stock. I do expect a small dividend raise coming up in about the next month or so, but stay tuned for that. Southern Company, I don't want to give any giveaways. I might be changing Southern Company. You can see if it'll be going up or down in the next month or so, so stay tuned for that. I just realized I skipped 3M. 3M is one that has raised its dividend. As of last month, they did raise that dividend a small penny, and that now makes 63 years in a row of consecutive dividend growth. And while this company did get ahead of itself back in late 2017, early 2018, this company is a turnaround play. This company has had so much negative sentiment around it from its debt load and laying off workers, but it is now revamping that business and restructuring the way that it does its products to focus on profitability and long-term shareholder value. This gives a lot of opportunity for me as a 3M investor as they get that dividend growth back on track. The payout ratio is a little bit high, but in the meantime, while they turn around that company, I've seen a little bit of share appreciation. Maybe, what am I up on the company? I don't even know. On a money-weighted return, I'm up, wow, actually more than I thought. I'm up 30% on a money-weighted return. But in the meantime, I'll be getting about a 3 or 4% dividend yield for the shares that I'm buying today, as well as a growing income, and that's one that I'm very bullish on through its 60,000 diversified products that it produces. And Kimberly-Clark is one that I just increased in my portfolio this past month or so, as you can see from this chart right here. And Kimberly-Clark has a massive yield, a very low PE ratio, and it's one that I'm betting on for the future. Extremely defensive, putting up record numbers. And once again, the same thing like with Lockheed Martin when we talked about this company going to all-time highs and then retreating since then. Now, since late 2020, we go back to August and its highs. In 2020, it did record numbers. In 2021, this company came out and said that it is projecting to do, once again, new record numbers. Higher revenues, higher profitability. Oh, and by the way, they also just announced a new share buyback program. They also just announced a higher dividend. I think it was about a 6.5% raise. So right now you're getting more payout as a shareholder than ever before. You're getting share buybacks, not share dilution, but share buybacks, which means your ownership in the company will increase just to wait. So if you were to own 1% of the company tomorrow, if you were to wait a year, 2, 3 years from now, and you never did anything, you would now maybe own something like 1.05% or 1.1% of the company just because this company's buying back its own shares. It's very defensive. They sell basic products like paper towels and toilet paper, but Kimberly-Clark, one I made previous videos about, go check those out if you want to see that. But Kimberly-Clark, very defensive, one that I'm betting on going in the future. Pepsi is one of my favorite companies. As a consumer, as an investor, it continues to remain to be one of the largest holdings in my portfolio. And let me tell you, anything under 150 of this company offers a lot of value. Anything where it's at right now, at say 120, 130, is a steal because it now has over a 3% dividend yield. They just announced a dividend raise, like I think it was about 2 weeks ago. And this company, once again, record numbers, downtrending. Record numbers are downtrending for a lot of these big blue chip companies because people are scared. People are scared of the markets, and they've switched so much to these big growth plays that they've abused a lot of these big dividend blue chip stocks. I'm for it. I'm all about it. If I could have this company go down to $100 a share, I would be buying it like crazy. That's not going to happen, but if it were to happen, this is the type of thing where I'm talking about. I'm not focusing on turning out a quick buck with a company like Pepsi. There are some companies in my portfolio that I'm looking at rotating in and out of because they offer some value over others, but a company like Pepsi, I'm not selling it. It could go down to $80 a share, $50 a share. As long as the fundamentals of the company stay the same, which I expect that to remain true, I think that Pepsi is one that I never anticipate on selling. For me to sell a company like Pepsi, let's go back here. We said it was, say, $130 a share today, okay? For me to sell a share of a company like Pepsi in 2021 without the growth behind it, I would have to sell Pepsi at a price that would be so ridiculous it would be irresponsible not to sell it. For me to start selling a share of Pepsi, maybe something like $500 a share. If this company were to reach $500 a share in 2021, I'd be like, okay, we're going to have to part ways. There's better places to put my money. But realistically, that's never going to happen. This thing probably won't even break 200 in 2021. And that's what I want to see. I want to see slow, steady growth for a company like Pepsi. And that's what I'm owning for a long time. Speaking of one that I'm owning for a long time, Procter Gamble is one that's also very defensive. They sell basic things like deodorants and shampoos. I'm expecting a dividend raise coming here in probably about the next month or so. Actually, they should be announcing it anytime soon, about the next week or two. But Procter & Gamble, one that's very defensive, your old grandpa stock, one that a lot of people have owned for centuries now, right? This company's been around for a million bajillion years. They have steady dividend growth. They have decades upon decades of dividend growth, as well as share price appreciation. And a company like Procter & Gamble, it's been around forever. I expect it to be around forever, and that's why I'm betting on a company like Procter & Gamble to continually increase its cash flows and fund my investments for my portfolio. Johnson & Johnson, the only healthcare stock that I own, and the only one that I'll probably ever own, because Johnson & Johnson is pretty much like owning a healthcare ETF. I've looked at other healthcare companies in the past, and I have to say, for me, pharmaceutical and healthcare companies are just really hard to wrap my brain around. Some people are better at other things in investments. Some people understand sectors better than I do. And there are some sectors that I feel like I know better than others. And healthcare is one that I just feel like is one of my weaknesses. I don't understand a lot of the pharmaceutical companies out there. So the way I look at it, if I'm going to bet on healthcare, if I have to own a healthcare company, then I'm going to own the best. And the same thing goes with like a JP Morgan. Financials is a sector that has been hit really hard in 2020. And where it goes in 2021 in the future, I'm not 100% sure. I don't know how a lot of these companies are going to fare out with the new fintech companies and interest rates being at 0% and the Fed balance sheet being at ridiculous levels. I don't know how a lot of these financials companies are going to fare out. So why not own the best of the best? The same thing goes for a Johnson & Johnson. Why not own the best of the best? So that's why I'm continuing to own Johnson & Johnson. And speaking of dividends, because you know I'm a dividend growth investor, they should be raising that dividend. I think, let's see, they're on track to raise it in May. So yeah, in about a month or two from now, they should be raising that dividend, so stay tuned there. One I'm probably never going to sell is J&J. Going forward, we have my next company, and this has been one that has been hit very hard recently, and that's Coca-Cola. Coca-Cola is having a green day today, and boy, it seems like that's the first one in forever, because if we look at the past 3 months, you can see it's pretty much just straight down. And they've had a lot of negative sentiment going around for this company, and I will say with Coca-Cola, they've had a struggle in the last 2 or 3 years. This company has had some shrinking revenue, but the good news is Coca-Cola has mass profitability. The cash flows that this company produces, it's insane how profitable Coca-Cola can be when it really focuses on its profitability. The good news is that give it some time to focus on repaying its debt, issue dividends to shareholders, buy back its own shares, and most importantly, the profitability that it's getting at now, it needs to focus on building out new brands, expanding revenues, because if this company just has its profitability and they continue to raise that dividend over time, this company will eventually catch up with itself. So this company is currently working on it, a big turnaround play. They're working on some brands to increase revenues for its shareholders, but I think that Coca-Cola will get back to its glory days. I think it will get back steadily to where it's growing revenues again at 3, 4, 5% every single year, just like Pepsi is, but right now they're at a bit of a downturn, and I'm buying this company now, expecting that turnaround to happen over the next decade in the 2020s. In the meantime, I'm getting over a 3% dividend yield just to own the stock, a huge name brand there, and one that is very defensive throughout any economic cycle, so one that I'm going to be betting on in the future. Speaking of companies that are very recession-proof, and if you look at this company in the 2008-2009 recession, this was one of the only companies in the S&P 500 that didn't go down. In the 2008-2009 recession, this company did great. They put up record numbers. And that's because when people lose their jobs, when people have lower income, where's the place that they go to? They go to cheap fast food joints like McDonald's. Being the largest hamburger chain on planet Earth, McDonald's is one to benefit from the vast majority of recessions. And the good news is, even when the company is not in a recession, when the economy is not in a recession, this company still does great. They have its revenues primarily coming from its tenants. So if its tenants, or I should say its franchisees, as long as they have their restaurants open, well, guess what? Rent's due, and McDonald's is charging you for it. So as they continue to build out new restaurants, as they continue to raise its rents for its tenants, or its franchisees in this case, this company will continue to sell hamburgers and fries and other products as well, including Coca-Cola products. But in the meantime, they'll continue to have compelling share price appreciation, incredible dividend growth, and that's why it's one of the most impressive stocks in the stock market, and it's one that I anticipate on keeping very large, just for its defensiveness. If you notice something about a lot of these companies, notice how defensive my portfolio is. I have some that will usually get hit a little bit harder from recessions, like say my real estate companies like WP Carey and Realty Income. But if you look at a lot of these names, okay, Visa, even in recession, is going to have mass profitability. JP Morgan, I mean, that's one of the most defensive companies in this portfolio. Do you think the government would ever let a company like JP Morgan go under? I really doubt it. Lockheed Martin doesn't really follow the economic trends because it focuses on strictly military products. The economy could go to crap and Lockheed Martin still usually does fine. That's how they grew profitability. And even throughout the 2008-2009 recession, this company still grew profitability. And you look at other companies, utilities, defensive, Kimberly-Clark, defensive, Pepsi, defensive. High focus on companies that have predictable cash flows and are usually very defensive. But this is one of my one exception to this is Caterpillar. This is an industrial company that is very cyclical, usually gets hit very hard in economic downturns, as you can see from the 2020 recession. They went to under $100 a share. And I started buying the stock like crazy. And I'm mad at Caterpillar for one reason only. I started buying this company like crazy at $100, $110 a share. This company has now doubled in share price. And the bad news about that is that I'm a long-term shareholder. I don't want it to go up rapidly in value. I want it to stay down near that $100, $120, $130 a share range so I can pick up more ownership of the company. Meanwhile, this company is it's pretty much a straight line up. Look at the year chart. Up, 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 and away, and now it's well over $200 a share. Now, the good news is I have a lot of share price appreciation. I've lowered my target percentage in Caterpillar quite a bit. Now, I'll see what I'm going to do going forward. I'm not really sure yet. This company's putting up some incredible numbers, but it has went up a lot in share price. It's not one that I'm planning on selling out of anytime soon, but who knows if I'll keep that target percentage where it is. Stay tuned. Speaking of target percentages being changed, one that I'm looking at changing very soon is Home Depot. And by changing, I don't mean taking down, I mean more than likely taking this company up, especially now that it's on the brink of breaking below $250 a share. Home Depot is one that I think offers a lot of value at these prices. Because if you look at this chart and you see that it's went straight up, you think, oh my gosh, you're buying this company at sky high prices. Now that doesn't tell the full story. This company has record revenue. This company has record profitability. This company has record dividend payout. Just raising it literally last week over 10%. Exactly 10%, I should say. It raised that dividend exactly 10%, from $1.50 to $1.65. Not to mention, with the massive dividend raises, like my other peers out there, like my other investments, it has share repurchase programs. It has opportunities going forward where its guidance is higher than it's doing today. It has 2022 and 2023 guidance that is going to likely be much higher than the number it's doing here in 2021. So Home Depot is one that I'm wanting to increase. And once again, with Home Depot, even if it goes up in value just for the track record and the type of monopoly it has on the home improvement sector, that's one that I always want to keep high in my portfolio. I really did get a little bit gun-shy trying to figure out what this company was going to do in the 2020 pandemic, and I obviously thought it was going to go lower, and I was trying to wait for that opportunity, and that's what I get for trying to time my investments. That's why I almost never do that, and I tried to guess the price with Home Depot, and I should have just put it as one of my largest investments like I intended on doing from the beginning. But Home Depot, one that I'm very bullish on, and now we move to my number one dividend yielding stock. It has a very high dividend yield of about 8%. I know it's went up the past couple of days, past week or two, it's went about 10% up, so now it's probably about 7%, but by far and away the highest yielding dividend stock in my portfolio, and also one of the most riskiest. Probably one of the only real risky dividend plays in my portfolio that has a major chance of cutting. And while this company is the largest tobacco producer on planet Earth, this company has a legacy business of producing cigarettes, but is slowly transitioning away from its old legacy cigarette business into new, more efficient ways of tobacco products like jewel pods and vapes and other products like that. Its e-cigarette business is steadily growing, as well as its cigar and cigarette business is growing as well. But the cigarette business is just, it's not good. It's not good at all. People have quit smoking in masses. But the good news is this company has extreme profitability. This company will sell a pack of cigarettes for $7, $8 a pack, and it will only cost them 4 or 5 cents to make it, literally. So when you think about that type of profitability, the opportunities for Altria, as well as its diversified investments in things like Kronos and Anheuser-Busch, and as well as its joint ventures in the Hexo Corporation, I think that Altria is going to be a turnaround play. I think it will be a very high yield, and I think it will be very boring. And I think this $40 and $50 a share range will be around for probably at least the next 1 to 3 years. But in the meantime, it will be turning around that share price, and more importantly, that dividend yield of 8+% will be here around to stay. At least that's what I'm betting. Real estate investment trust store capital, pretty much the same thing as Realty Income and WP Carey like I was talking about. They have a little bit of a new revamp on real estate, but pretty much the same thing. They're going to build out new properties. They're going to sell those properties to its tenants, or I should say rent them out, rent out their properties to their tenants. It's going to get profits from those. The properties themselves are going to go up in value, and then they're going to build new properties as well, and the cycle just repeats itself over and over. Store Capital did get hit very hard in 2020. It's bouncing back very well in 2021. I've had some great gains as well as some great dividends, one that I really enjoy owning. Next are Energy Partners, the only energy company in my portfolio that I own. Once again, energy, a sector that I'm not very knowledgeable about, one that I'm not super bullish on, but this is a company that is renewable energy. In between its very high 3+% dividend yield and raising that dividend payout 3 to 4% every single quarter, not annually, but every quarter. So on an annual basis, this thing's raising its dividend usually on average like 13% a year. So very high dividend growth, a renewable energy play that I'm going to be holding going well into 2021. And then next up we have a company that I might be looking to replace. I've mentioned this in some previous videos. I don't know. I've had a lot of gains from this company, and when I was buying this company at literally $30 and $40 a share, it offered a lot of value. And Cisco has an incredible track record. At the time, had an incredible dividend yield, but now that dividend yield is not as incredible as it used to be. They held up on raising that dividend. The profitability is down, and while the company does have a lot of success going into the future, I think this is a company that I could see being replaced in the coming decades. They don't really have a compelling business model that I just say to myself, wow, this company just can't be replaced. They just basically deliver food products mostly and other products as well. And when I look at a company like Cisco, it's one that I like owning. It's one that I don't want to sell out of, but there is better places to put my money, so stay tuned. And next up, we have Waste Management. Of all the companies that are defensive, I keep on talking about the defensiveness in my portfolio. Waste Management is one of those. This company cleans up trash. Do you think that people are still going to create trash no matter if they have jobs or not? If you have a job today, you're going to go into your kitchen, you might make dinner, you might have bought something from the grocery store or from the gas station. You're going to have trash, you're going to have packaging, you're going to have food scraps, you're going to throw that in the garbage. If you lose your job, this situation stays the same. If you're at home, you're eating food products, or even if you go out, even if you leave your home, if you go out to a restaurant, you go out to a fast food joint, to a grocery store, you're going to create trash. Guess who cleans up that trash? Waste Management. Guess who makes money from cleaning up that trash? Waste Management. That's how this company continues to raise that dividend, including the raise that they just announced, and that's why this company has a lot of share buybacks planned coming for the next decade. And this company is at a pretty good valuation. It's a little bit rich right now, and the dividend yield isn't anything crazy, but when I think about the defensiveness and the long-term growth opportunity for Waste Management, with the positive free cash flows that this company produces, it continues to find ways to offer value to shareholders through a lot of acquisitions as well. So Waste Management is one that I'm betting on, and one that I could sleep well at night throughout any recession. So one I'll anticipate on owning for a long time there. Next up, we have Verizon. Verizon, I made a complete video about it, so I won't go into details there. Go watch that recent video I just made about Verizon, but the cash flows that Verizon produces, it is insane how profitable this telecom company is. And all telecom companies in general are pretty profitable, but Verizon, it's pretty crazy. And the funny thing is, right before this little jump up right here, I just made a video about Verizon and talking about why I'm buying it. And then Warren Buffett announces the next week that he initiates a pretty big position on Verizon. So one that I'm going to be buying very heavily, one that I'll continue to own in my portfolio and get the steady, boring cash flows from Verizon. And then last but not least, once again, a company that I might be looking to replace. I'm so sad with Starbucks. And the same thing like Caterpillar, I'm angry with this company. If you would have told me that it would be reaching well past $100 a share in early 2021, I would think you were crazy. I would still think this company would be trading at $70, $80, maybe $90 a share at the most. But now this company has a valuation that is very rich. For just a company that sells very expensive coffee, well, I think their branding power is incredible. I think their management team is awesome. The dividend growth is awesome. It's hard for me to justify continuing owning just a coffee chain at $100 a share. The valuation on this company is getting very rich. It has a PE ratio that is now upwards of 30, and so there's probably better places to put my money. So stay tuned with Starbucks. The dividend payout is not that great, and I could probably put my money better places. But overall, guys, thank you for watching all the way to the end. Like I said, we have 101 people signed up. Go ahead and get signed up with that and check out all the stuff that is down below in the description. But thank you guys so much for watching, and I'll catch you guys next time.